Guys, good morning and welcome. Welcome back to work. Thank God the weekend is over. So we'll kick off our pre-market prep here for Monday, May 9th, and a quick look, guys, at the futures. The bloody nose continues. The S&P 500 is down 1.5% heading into the open. QQQ futures are down 2%. The Dow Jones is down about 1%, and your Russell 2000, the small caps, are down about 1% as well. So the selling pressure continues, and one really important chart I wanted to share with you this morning is going to be the weekly squeeze of the S&P 500. You can look at the SPY, you can look at the futures. We've been focusing on the SPX, all pretty much the same from the perspective of we're in a weekly squeeze. We are under the weekly 21. There's a negative histogram. This still hasn't fired short yet. Right? Inside of that weekly squeeze, there's a 3-day squeeze under the 21, negative histogram, still hasn't fired short yet. So I show you this to say if you're under any kind of thought process or any type of thinking that the market can't trade any lower, you've got to focus on the weekly squeeze because from a percentage standpoint, SPX goes from, we'll call it 48.20. So 48.20 at the high. Now we're down here at 41.20. So $700 off the high, the 14% pullback. But to look at this current structure and to think there's no way the market can trade lower, basically it would be the same thought process as back here in this bullish weekly squeeze, thinking the market can't trade any higher. So granted, there's names like Netflix, I think 60, 70% off their highs. There's names like Amazon, Facebook. There's been some good selling pressure, but I think the most important chart here is going to be the chart of that S&P 500 and the fact that we're in a weekly squeeze that still hasn't fired short yet. I think we've got plenty more room to go, guys. And then the other chart I want to show you here, and we'll look at this on the futures as they're trading. So kind of, like from the bottom to the top, like a ground up approach. The daily charts are a total mess, and there's sell signals everywhere. Then there's this bearish weekly squeeze that still hasn't fired short yet. But then if you want to take a really big picture look at our market, well, we know we had that giant monthly squeeze that fired long, basically after COVID, that gave us that crazy push. Now, in terms of like the stages of a trend, like the ebbs and flows, we go into a squeeze, we build up a crap load of momentum, we release all that energy. Then as that histogram starts to shift, light blue to dark blue, just basically telling us that momentum's starting to run out. We're getting a little bit tired. So in terms of a healthy pullback, what you would look for would be the pullback to the 21 EMA. You would look for consolidation, but then you would look for that trend continuing off of that monthly 21. Right? That keeps this bigger picture trend intact. A really similar perspective would be if we looked at the weekly chart, guys, of the QQQ. Same concept. Big push to the upside. There's the pull back to the 21 EMA, and the trend continues. So that's what you're looking for in terms of, okay, this market's going to continue to trend higher. But then, of course, back in January, we start to trade under that weekly 21. And everything's kind of unraveled since. So from a trend perspective, understand the significance of being in a bearish weekly squeeze as your monthly chart is potentially starting to shift some major structure. We haven't been under the monthly 21 EMA since COVID. So all things to keep in mind, guys. Now, with that being said, and the S&P is down about 1.5% here ahead of the open, I do think there's plenty more downside to come. I don't think this is where we want to aggressively get short. And it's a discussion we have all the time, so nothing new. But your friendly weekly reminder, we've got to be a little bit careful about getting short down here at -2 ATR. and we can go look at 20, 30, 40 years of history, we're going to find some examples of times where we could get short at -2 and still have a nice trade. But in terms of creating good habits and in terms of consistency, this is typically going to be a pretty unenjoyable spot to get aggressively short. Right? And if we're playing a bullish market, so if we look at the inverse chart of the S&P 500, okay, we want to buy the dip. Right? We're bullish. We're above the 21. We've got all the reasons to want to get long. We want to be careful about doing that up here. We jump in at 2 ATR, we might have to sit through that pullback. So the same rules apply to the short side. And like I said, certainly feels like a market where you can short here and you might catch a nice move. But at the same token, we're down at these extensions. We're down here, at major support. And then if you look at the put call ratio from Friday, which I think might spike even more this morning, remember when that put call is pushing through 1, everyone and their mama is getting short. And again, there's going to be times where everyone and their mama is correct. You have to keep in mind, any moment here, there's a potential for a nasty short squeeze. So, of course, in hindsight, I would have loved to have shorted the market on that pop after the Fed. I was thinking we got a little bit more to the upside. So be careful getting short, guys, until we get a decent bounce. Not saying we're going to get one, but we don't want to lose that discipline. Now, one name I would love to short, this is kind of going to be my major focus, would be Apple. So compared to its get a weekly chart, compared to its peers, so to say, Apple has held up really well. So compare Apple to Facebook, to Netflix, to Google, to Amazon, and Microsoft not too bad actually. But definitely, Apple's held up a lot better here. I think it can only buck the trend for so long. So in the event, sure enough, the S&P 500 fires a weekly squeeze short, I think you're going to see Apple roll over. And then in terms of Apple's structure, weekly squeeze, histogram rolling over, no stacked DMAs. Then inside of the weekly squeeze, there's a bearish 3-day squeeze, no stacked DMAs under the 21, negative histogram, to up the ante daily squeeze with some sell signals. I would love to short this around 160, 162. And here's a trade I would like to get. Keep in mind, I'm not going to force the issue here. So it's basically no bounce, no trade. But what I would like to do is the June expiration, 165, 145 put debit spread. So for June 17th, we're going to buy the 165 put, and we're going to sell the 145 put. And you'll notice it's going for about $8 right now. What I would like is to see the market try to squeeze the shorts. Let's get a decent bounce here in Apple. If Apple bounces, this debit spread gets a little bit cheaper. What I would like to do, try to pick it up for $6.50. So in terms of risk reward, obviously max loss of $6.50, max profit of $1,300. So in terms of best case scenario, worst case scenario, you're risking 1 to make 2. But more importantly, if we can get this for about $6.50, then I can work a really good risk reward between my profit target of 145 and my exit around 165-ish. So that's my thinking. As long as Apple's under the weekly 21, negative histogram in the squeeze, I'm looking for this to flush down to -2. Apple starts to close back above the weekly 21. It's probably not ready to roll over. So check this out. If we could get that spread, if we could get that for $6.50, look at the risk reward, say into May 27th, up at 165 on one contract, uno contracto. On one contract, a push into 165 we're down about $400. A move into 145, you're going to net about $800. If you could move into 140, you're up about $1,000. So no matter how you slice that, it's a good risk reward. If we can get it for a little bit cheaper than $8. So that's what I'm lining up on Apple. And then one more trade idea here, guys. And keep in mind, these are just ideas. So, you go into the session with your ideas, with your game plan, but then you're looking for things to come together. You're looking for edge. You're looking to make sure, say you're looking for a bounce here. You want to see the volatility index fade. You want to see strong internals. You're looking for as many things as possible to support your idea. So for now, it remains an idea, but one idea is that as we're a little bit oversold here, keep in mind, the next Friday is going to be monthly expiration. Again, can't stress this enough, just an idea until we start to see some internals and VIX fading, a few other things, but just an idea. We do have monthly expiration next Friday. Not always, but pretty frequently. They'll kind of flush the market the week before monthly expiration. Then you kind of get what we refer to as a pit bull low, is they kind of rally the market into monthly expiration the following week. That's where you get the potential for a lot of pinning plays and things of that nature. Just an idea, but down here at -2 ATR, with the put-call ratio spiking through 1, in monthly expiration around the corner, I will be looking for signs of some potential short squeeze. It's a very short-lived bounce. One way of trying to play that is basically the idea we discussed last week with the unbalanced put fly. So if we go to May 20th expiration for the SPX, and as far as the placement of this, I'm not too sure. I'll have to see how things kind of settle at the open. But for conversation's sake, let's say we're working the idea. We might catch a nice bounce here into monthly expiration. So, one trade we could look at, let's see what this looks like. And we're going to buy in unbalanced butterfly. Let's go $10 wide. So 39.60, 39.50, 39.40. We'll look at it on one contract. So 132. All right, let me check this out. Okay, so if you look at this unbalanced put fly, don't get too caught up in max loss, max profit. So max loss is $700. Max profit is about $1,300. So sounds attractive. You get that max profit, or you get close to it, if come expiration, we're pinning and closing basically right at 39.50. So it's basically like a put butterfly from that perspective. If the market flushes and if we can somehow close monthly expiration around 39.50, we might get a decent chunk of that $1,200. What's a little bit more likely, my thinking is we could bounce here. So my thinking is come next Friday, or the idea you'd be looking for this trade is come next Friday, we're going to be trading well above 39.50. Got to go to a weekly chart here. Right. So if we flush, we happen to close near 39.50, you might catch the pin. What I'm looking for is come next Friday, we're nowhere near 39.50. You're looking for that bounce. So in the event you catch that bounce, if we can buy this fly for about $2.80 of credit, so you buy the fly when it's worth $2.75. This coming, or next Friday rather, if the SPX just closes anywhere above 39.50, the butterfly expires worthless. So that $2.75, or that $275 per contract, that goes into our pocket. So from that perspective, it behaves like a put credit spread. But if we do flush here and we're dead wrong, if they can try to nail this thing around 39.50, you might have some pinning action. So it's your put credit spread with your butterfly built in, basically. Now, in terms of the realistic risk reward, if we look at the butterfly, say you're comfortable holding it all the way down to 39.50. Like, you're going to really give it all that room. Well, into Thursday, guys, if we're pulling back to 39.50, 39.50 come Thursday, we're down about $200. So the risk is a lot smaller than the 700 and change you got to front to get into the nightclub here. So if these are newer to some of you, and I'll put out a video here over the next couple of weeks or so, but that is one potential idea. It's like, hey, I think we're going to bounce here. Let me try to sell some premium. But maybe I tweak this thing into an unbalanced fly. Just in the event we flush, maybe my ass is covered if we can pin near that short strike. So there's a few ideas, guys. Real quick look here at the bullish watch list. Then we'll answer a few questions, and I got to get ready for the options room. In terms of the bullish watch list, though, nothing has changed. It's going to be your energy components: Chevron, ExxonMobil, Oxy, FANG, LNG. It's going to be UNG, natural gas, like that on a dip. And then I think U.S. oil, USO, Superman, that. USO would be nice on a dip to the 21 EMA as well. And then, believe it or not, got to give respect where it's due. You've got a nice daily squeeze in wheat. So the theme this year has been the good-looking bullish opportunity, probably for like 90% of us, is in spots that we probably have never focused on. I've never focused on wheat, never focused on agriculture, never focused on, the LMTs, things of that nature. But there you have it, my good people. Energy, U.S. oil, UNG, and then basically every other sector is hitting you with a sell signal here. Slim pickings to the upside, and then Hershey. Hershey is looking pretty solid. So that is where we are at. It is May 2022. Netflix is 70% off the highs, and Hershey is one of your better looking setups. Who would have thunk it? But all right, guys, before I cut you loose here, if you got any questions, any charts you want to take a look at, let's get it done. Hey, good morning, Sebastian. Good morning, Mimi. What's up, Big Terry? Good morning, Gene. You're dreaming. Market coming down. This market is overvalued. Stop their bullshit. Stop their bullshit. Well, Jimmy, if you were listening, I'm looking for a bounce to short here. We're on the same page here, Jimmy. We're on the same page here, Jimmy. Gene Pinero. I used to know Nick Pinero. What strike put calls did I play for Apple? Gene, the short I'm going to look for is going to be the June monthly expiration. So June 17th monthly expiration, 165, 145 put debit spread. And I'll make sure I keep covering that here on the channel over the next few days because there's one short I would like to get open. Hey, good morning, Steven. What you got, Steven? Let's see what Steven has got here today. PXD and Rock. PXD. I had a feeling PXD was going to look pretty good. Straightforward. I think you try to buy this on a dip. Now, if you're thinking we're not going to get a dip, this is so strong, you're just looking for continuation, albeit always a little bit risky up here at plus 2 ATR, what you could do is just lower your time frame to something like a 15-minute chart. So if there's a 15-minute squeeze, I think it's a little extended, but you could jump into that 15-minute squeeze for a shorter-term trade, very much like back here. So I think in terms of looking to play it in a bullish fashion, you're either going to look for a pullback buy, or ideally, I think with smaller positions, you're going to look to catch that next 5-minute, 15-minute squeeze for the continuation push. But it looks pretty good, and it's in the right group. It's in the right group. I'm an ROCC. Weekly 3-day, 4-hour squeeze. And you're right on top of your launching pad. 4-hour squeeze looks good. Yeah, nothing bad I can really say about it. It's playing cleanup, which is exactly what you want to see. Back above the 21, histogram's trying to shift. It might need a little bit more time to keep working momentum in the bulls' favors, but it does hold up pretty good there. All right, next up we have got GGPI. Let's see what you got there, Simsha. GGPI. So this is something I look to short the bounce on. Major reason being I got my sell signals, but I wouldn't want to short it down here. So kind of the same thought process. I want to short the S&Ps, I want to short the Qs, but I prefer to do that on a bounce. So that is a game plan I would look to work on this one. Where I would start to feel like I'm wrong on that game plan is if we begin to close back above the daily 21. I don't want to be shorting over here, thinking we're going to flush, and then still hanging on weeks later. That can get a little painful. But that's what I look for on that one. And then Flaming Giraffe. I like that name. I like that. BMY, I think, one of the cleaner names in the market. So we definitely got this on our watch list. Trend, structure, momentum, daily 4-hour, 2-hour, 60-minute, 30-minute, 15-minute squeeze. Fixing to do something, I would argue. But what I love about this is the domino effect. If that 15-minute squeeze fires, that could trigger the 30-minute. If your 30-minute squeeze fires, that could wake up the hourly. That could wake up the 2-hour, so on and so on. The 4-hour looks pretty prime too. Above that 21, histogram shift. So yeah, I think BMY looks solid. Only thing we got to keep in mind though, and this goes for energy, this goes for a lot of the better looking bullish trends, a close under the weekly AEMA could open the door for a flush down to the weekly 21. Meaning in terms of the easy stages of this trend, we are a little bit late. I think we can play it, but we got to keep in mind, we take out that AEMA, could be coming in towards a 21. So that's, all we got to do there is keep our losses nice and tight. So the game plan that I would work is I'd exit the trade. If it's looking like come Friday, we're going to get a weekly close under that AEMA. And then you're going to look for a push, I think, towards $80 here. So a little bit of risk, some nice reward. I do like that one. But all right, guys, I'm going to cut you loose here. Go heat up the coffee, and then I got to jump into the options room here in about 10 minutes. So, as always, guys, I appreciate your time. Hope you have a good day. Jimmy, I hope your day gets better, and I will talk to y'all soon. Be good.